we've got this 5-year phase to roll over the world debt. And of course, the U.S. is at the forefront of that with $30 trillion in debt. That is being issued at different maturities. Now it's being issued really at the short end, but it has an average maturity of 5 years. And so we have this new technology, Bitcoin, which is about 1% global adoption right now. So 1% of the world uses Bitcoin as kind of their main savings vehicle right now. I'm one of them. Now, what does the power law predict? Well, power law predicts that 10 years from now, more or less, we should hit around 1 million in terms of Bitcoin price. Now, we could hit 3 million.
The new so-called standard model for Bitcoin might sound reassuring, but there's reason for skepticism. It claims to integrate liquidity, halving cycles, volatility, and adoption patterns to explain price movements. However, what's really at play here? Liquidity. And not just any liquidity. Bitcoin seems unnervingly reactive to changes in money supply, more so than traditional assets. When Bitcoin's price plunged in 2022, this model conveniently pointed to the Federal Reserve's liquidity tightening, conveniently brushing aside the supposed impact of halving cycles. Fred Krueger, in a recent podcast, pushed this narrative further. He claims that various quants have bought into this model, with its fancy mentions of power laws, liquidity-driven pricing, and S-curves. But let's be clear, while Krueger tries to paint a cohesive picture, it's hard not to feel uneasy about how much weight he places on liquidity fluctuations, something Bitcoin enthusiasts have long touted as irrelevant to a supposedly decentralized asset. Tracing the model's origins back to Solomon Brothers in the late 1980s, Krueger suggests that even bond market research back then was pivotal to understanding money supply today. But doesn't this raise a red flag? Bitcoin, often heralded as a hedge against traditional finance, now seems to be deeply intertwined with the very systems it was meant to escape. For further insights into Fred Krueger's conversation, be sure to watch clips from the interview. Please like this video, subscribe to the channel, and turn on post notifications for more content. Enjoy the video.
Let's talk about the standard model, and let's start with liquidity, right? Because the most, in a day-to-day basis, I think the thing that could drive the most price is liquidity. And what do I mean by liquidity? Well, broadly, I mean money supply, M2. The main thing is refinancing the debt, right? Because the debt has become such a huge number that the cycles all revolve around refinancing the debt. And these tend to be actually measured as 60-month or 5-year cycles. And where the 5-year number comes is that the average maturity of the debt is about 5 years. We've got this 5-year phase to roll over the world debt. And of course, the U.S. is at the forefront of that with $30 trillion in debt. That is being issued at different maturities. Now it's being issued really at the short end, but it has an average maturity of 5 years. And as Michael said, the real goal of the real mandate of the Federal Reserve is not to cut protect against inflation or to protect against unemployment. The real mandate of the Fed, the unspoken real mandate of the Fed, is to make sure that the bond market operates and that the U.S. government can tap the bond market for its issuance, right? So anyways, that's the liquidity side of it. Now, as Howell notes, and in his studies, if you increase the liquidity by 10%, the gold will go up 10%, but Bitcoin will go up 40%. So Bitcoin is extremely sensitive to liquidity. And we saw that there was a fall in liquidity, about a 20% fall, a 10% fall in liquidity from 2022 to 2024. And the first phase of that caused a real drop in Bitcoin in 2022. And so, that was probably more liquidity driven than halving driven. It was really driven by the liquidity, the Federal Reserve tightening interest rates. So now we have the Fed on our side. We have money printing. We know that as the Fed's pushing, right? Bitcoin's going 4x on that. So that's the liquidity side. Now we have the power law side, completely separate. The power law is really much more of a story of adoption. So we have this new technology, Bitcoin, which is about 1% global adoption right now. So 1% of the world uses Bitcoin as kind of their main savings vehicle right now. I'm one of them. I hope you are as well. If you have been using Bitcoin as your savings vehicle, you've been doing very well recently. So that 1% is growing by roughly the time since the Bitcoin was invented in the Genesis block in 2009 till now, right? So it's been growing for 15 years. And the power law says that as it's growing, as that time since the Genesis block has happened, it's growing at roughly 5.7 power of that time, right? So it's growing at a very high rate, at a rate that is faster than an exponential rate of money supply growth. So money supply growth is growing at 10%. Bitcoin's growing at currently at about 45% compounded annual growth rate, right? So, 4 times faster than the money supply is growing.
One key point that Krueger highlights from Howell's recent analysis is the significant focus on refinancing debt due to the immense levels of debt worldwide. He explains that debt refinancing typically follows 5-year cycles, which correlates with the average maturity of debt. Krueger describes the US as being at the forefront of this issue, with trillions of dollars of debt needing to be rolled over. He notes that the Federal Reserve's unspoken mandate is to ensure the bond market operates smoothly. Krueger then discusses the importance of liquidity cycles for Bitcoin, observing that Bitcoin tends to respond dramatically to changes in liquidity. He reinstates a saying from Marty Zweig: just as you don't fight the Fed in traditional markets, the same principle applies to Bitcoin. Fred believes that now that liquidity is returning through money printing, Bitcoin is likely to respond strongly, potentially multiplying in value. Let's go back to the interview and watch more clips to gain insights from Fred Krueger.
According to Metcalfe's law, it's becoming more useful. There's more people buying into this new money paradigm. And the result of all this is that we have this very, very high growth in Bitcoin price, but it's a high growth with high volatility, right? Now, really hard to understand, to see any rhyme or reason in this volatility when you look at it in just regular space, or only if you look at the price in log space. You really need to look at the price and time since Genesis block in log space, so log space. And then you can measure volatility and you see it's 0.3, which is actually very high, but not so high in log space, right? So, and it's actually dampening a little bit. So, we have this very good model now for Bitcoin prices, and let's just call it a historical model, right? We don't need to say it's a predictive model, but we know it's a historical model. The fit is excellent. You can't argue with this. Now, if you try to fit an exponential model to it, you will find the fit is not good. So this model fits the power law. It does not fit the exponential. The data does not fit the exponential hypothesis. Actually, at this point, the data does not fit Plan B's model at all. So Plan B's system is invalidated by the data. And I really think we should just drop Plan B, because Plan B was an early model, and a lot of people sort of perceived it as the standard model. They didn't think of it enough. They didn't analyze it enough. And I now think we can discard that model. And we really have this power law model, which is the genesis of a really great model. So if you add in the liquidity model and the power law model, and then we also take into account sort of historically the halvening cycle, right, which was very significant in the first two bull markets of Bitcoin, right? In 2013, when the halvening happened, and these halvenings were very, very significant. They made an enormous amount of difference in terms of supply. Today, not so much, right? We've mined 95% of all Bitcoin, and the halvenings will matter for the miners, but they won't matter so much for Bitcoin holders, because, we're mining right now 450 Bitcoin a day. BlackRock just bought 2,400 Bitcoin, BlackRock and Fidelity and the other ETF provider, but they bought 2,400 Bitcoin yesterday, right? So between Michael Saylor, the ETFs, this is not a question of who's going to buy this extra mining supply. That it's just no longer relevant, and that's just a bad model to have in your head, that there's this finite little amount of new Bitcoin that is, and you know, if that thing drops, it's going to make an enormous difference. It really won't, because if we're mining 450 Bitcoin a day right now, if we drop to 225, which we will next halving, it's not going to make that much difference. Those 200 Bitcoin a day are not going to make a world mountain of difference. So there will not be a supply shock, but there may be a liquidity shock worldwide, and there probably will be in 5 years, because we'll probably go through another liquidity cycle, because we always tend to do that. And so, you know, I think liquidity cycles will continue. Halving cycles, probably not, if I had to guess. And of course, we have this power law of adoption, et cetera. So put all these things together, we now have a very consistent model of Bitcoin. We have a model with an R squared of 95%. We have a great understanding of liquidity cycles. We have a great understanding of why Bitcoin is growing. We have models of adoption.
As of September 26, 2024, Bitcoin has experienced a remarkable price surge of 141% over the past year, significantly outperforming traditional assets like gold and the S&P 500. A recent report from VanEck highlights that a critical factor contributing to this rise is the increase in crypto venture capital, VC investments, which have surged by 87% within the same period. Bitcoin's market capitalization currently stands at approximately $1.25 trillion, reflecting a 15% increase since last year. Bitcoin is evolving into a more established role as a store of value and a tool for wealth transfer, rather than merely being seen as a speculative asset. Fred Krueger has also pointed out that this shift towards institutional adoption could enhance Bitcoin's long-term stability, but it introduces challenges, particularly around scalability and energy consumption, as noted in the report. Meanwhile, Matthew Siegel, head of digital assets research at VanEck, emphasized that the forces driving Bitcoin's adoption today differ from those of 2023. In the previous year, retail demand and viral innovations, like inscriptions, played significant roles in its growth. However, the current landscape indicates that institutional interest and a deeper understanding of Bitcoin's utility in financial systems are now taking center stage. As Krueger has discussed, how these factors interact will be key in determining Bitcoin's trajectory in the evolving world of digital assets. As we come to a close, what are your thoughts on the models discussed? Which do you think is the best fit to solve liquidity? Please share your thoughts in the comments below, share this video, and hit your thumbs on the like button. Thanks for watching, and don't forget to subscribe.